Hello again, everybody. In my recent 2020 almanac, I examined a lot of simple ideas that I think every system developer has thought about. Are there biases to, for example, buying the market after an up day? Or the other side of that, is there a bias, in fact, to buying after a down day and doing the exact opposite on selling short? Well, in the almanac, it was mishmashy. It worked in one direction on some of the markets and in the opposite on others. So, part of what I wanted to show people was stuff they may have thought about that they shouldn't waste their time on. Well, it turns out that you can get a bias on daily bars by just adding one little condition. All right, we set up our charts for daily bars, again, day session only, 8:30 a.m. to 3:15 p.m. Central Time. And we're looking at a down day, close to close down, okay? Today's close is less than yesterday's. And if, when you take today's close away from yesterday's close, you get a distance that's at least 75% of the 5-day range. Again, we're talking the day sessions only, 5-day average range. And the net change, close to close, is at least 75% that size. Then we buy tomorrow at the 8:30 a.m. open. If today's close, now this is following an up day, a day where today's close was higher than the previous day's close, okay? In that case, if today's close minus yesterday's close is at least 75% of the average 5-day range, sell short, okay? So we're fading the close to closes net changes, and we're saying that the distance between those two closes have to be at least 75% as large as the average 5-day ranges. Okay? And we exit at the 3:15 p.m. close. All right, so this study was originally run through April 9th, 2020. And it didn't look too shabby, did it? S&P, $47,000 profit off 855 trades. 364% return on account. Go down to the NASDAQ. You got a return on account of 705%. That was from $71,000 with a worst drawdown of 10,130. It's pretty close to manageable, right? All right, so again, we're revisiting something that I did before, meaning that from that time until now is pretty much virgin territory. For all practical purposes, real-time trade, right? Because what we're going to be seeing is what happened after the jerry-rigging and fitting, weighing and balancing of the system. So how does it look? Well, in all honesty, it's kind of a mixed bag on this one. We've given back a little bit in the Russell and the mid-cap, but what we've given back in those two is not as much as we gained in the other three, right? $13,000 over a roughly 6-month period in the S&P, another 6,000 plus in the Dow, and a whopping figure that comes close to, I'm doing this in my head here, $28,000 in the NASDAQ. And the return on account jumps from 705 to 782. So, not too shabby, people. Check this out. Check this out. I try to answer everybody. And thanks for joining me.